Welcome back. So what you've done right now is you have prepared financial statements. They are out there, they're going to get audited, and then they're going to be put out there for the world to see, okay, if you're a public company. Otherwise, you've just produced them for yourself. One thing I just wanted to call out that I did not before is I wanted you to realize one thing about the range of time on these things. And what I mean by range of time is if you look, the income statement is for a period of time. It's for the year ended December 31st, right? So it covers a 12-month period, all the revenues, all of the expenses that you've accumulated in 12 months. Statement of retained earnings, kind of the same thing in the sense of that dividends is, these are the dividends paid this year, okay? The other numbers, well, we'll get back to the other numbers. So the same idea here, year ended. These are the numbers, this is everything that happened during the course of the year, right? If you start off with January 1st, this is what happened during the year, and here you end at December 31st. The balance sheet, though, it's a snapshot. This is for today. This is how much money I have in my hand today, how much cash is in my account today, how many receivables do I have today as of December 31st. Not for the time period, right? Just today. So these are the assets today. These are my liabilities today, right? Tomorrow they're going to change. Tomorrow money's going to come in. Tomorrow I'm going to have bills to pay. Tomorrow I'm going to do some, do other things. So these numbers change, but they stay, meaning that they don't have to be zeroed out at the end of every year. Okay, so that leads me into the closing entries conversation. Closing entries, let's remind, okay, so here's our three statements that we're talking about here. You've got your income statements, right? Revenues and expenses become net income. Net income, it's kind of my summary slide here. Beginning retained earnings plus net income, which you need from here, minus dividends, gives me ending retained earnings. And then you've got your balance sheet, your assets, your liabilities, and your stockholders' equity, right? And we talked about how these flow from one place to the other. Now here's the thing. What we have to do with closing entries is we have to make some accounts zero because we have to restart them for the next year, right? We don't count income from like the first day of our business until, end of year 50. We start with new revenues every year. Revenues as of January 1st through December 31st. That's what we report, right? If it's a calendar year company. And then the next year, we start from scratch. We start reporting from that January to the following December. So there are certain accounts that we have to basically make zero. We have to close them out. And some of those accounts are revenues and expenses. We have to zero these out, right? We have to make them, well, you'll see. We'll have to zero them out. And we also have to zero out dividends. Those are temporary accounts. We close them all out to retained earnings. If you see that here, and retained earnings is actually a permanent account. All right, so all the accounts that are here are considered permanent accounts. The way we do that is we close revenues and expenses to an account called income summary. Don't worry, you'll see it in action. And we close that to retained earnings. Right, so really all of these things, revenues and expenses become net income, right, minus dividends, and they all accumulate here into one place. They all wind up being in retained earnings. That retained earnings is a result of a lot of things happening before it. All right, and like I said, these accounts are considered permanent. Oops, got a little ahead of myself. They don't go anywhere. They're here for the next year. Assets don't go away just because it's a brand new year. Liabilities don't go away just because it's a brand new year. But these do. We do have to reset these accounts to zero so we can start tracking the revenues and expenses of the new year. So let me show you my little example with cups, and I'll show it to you with numbers. So we've got revenues. Make sure it's the right way. Yeah, you can see. All right, you've got revenues, right? And we're doing this with push pins instead of paper clips, which is usually what I like to use for this example, but I only had push pins, so I'm risking my life here showing you this example. All right, I could wind up with tetanus. All right, so we have revenues, right? Let's pretend these are the dollar amounts of revenues. So I have revenues, and what I'm going to do with those revenues is I'm going to put them into this new account called income summary. All right, so I'm going to save all the revenues, and I'm going to dump them into my income summary account. Okay, my revenues are now zero and ready for the next year. I'm going to do the same thing with expenses. I'm going to take all of my expenses, the dollar amounts that are in here, and I'm going to put them into income summary. My expenses are now zero and ready for next year. Now what I have in here in my income summary, this little account, this new account that we haven't heard of before, is what I have is I have all the revenues and all the expenses. So if you think about it, what I really have in here at this point is net income. All right, so that's the dollar amount that I have in there. What I'm going to do is I'm going to take this income summary and I'm going to put them into retained earnings. All right, an income summary has done its job for the year. All right, this income summary account doesn't go anywhere, doesn't get recorded anywhere. It's simply used for closing entries. We take all of our revenues and expenses, put them in income summary, and then put them as one number into retained earnings, which if you see is happening right here. Right, revenues and expenses are going into retained earnings right here with this arrow. All right, the last thing I do is I put dividends into retained earnings. And dividends are now reset for next year. So if you think about what's in here, it's all the revenues, all the expenses, which are net income, and the dividends. And that is your final ending retained earnings. All right, so now you have to appreciate how cool this is. Now I want you to think about it a different way. Realize that all of these revenues, expenses, and dividends, they're temporary accounts. Get it? They're paper cups. And income summary is technically a temporary account as well, but it's a little bit different. It's not a normal account, right? We're only using it for closing entries. Get it? Okay, so right, one last thing. Retained earnings is a permanent account. It is a real cup. All right, so that was my fun thing. You got to give me something because, you know, accounting only has so many jokes I can throw into it. That was one of them. Okay, so let's move on to numbers. So, very simple example. We have revenues, we have expenses, we've got dividends, we've got this income summary account, we have retained earnings. So I'm showing it to you in T accounts because I think that's the easiest way to see it. And they actually even have the steps here for you to look at. First step, close revenue. So how do we close revenue? Well, revenues right now has a credit balance. And what I want to do is I want to reset it to 0. So I'm going to debit service revenue. And that's going to give me a 0 balance in that account. That's what I'm trying to do. I'm trying to reset all the temporary accounts to 0. And what I'll do is I'll do that with the offsetting balance. So if it's got a credit balance, I'm going to debit it so it's 0. So, and well, I'm going to write it down in a second. And then my credit, though, is going to be the income summary. Remember, we dumped from revenues into income summary. So if you have a debit here, then that's got to be a credit. So your first journal entry is a debit service revenue, credit income summary. All right, we've just closed revenue. Now to close expenses, if they carry debit balances, we're going to credit them. So $1,400 credit there, 0. $600 credit there, 0. You would do that to all of the expense accounts. And we put them into income summary. So we've got a credit to salaries expense, a credit to rent expense, and one debit to income summary for the sum of the two, $2,000. We're going to put $2,000 in there. Okay, so what we've just done is we've taken the paper clips, not paper clips, push pins, the revenues and the expenses, there we go, the revenues and the expenses, and we put them both in income summary. Remember, we reset them to 0. If you don't remember, rewind that part of our conversation. Okay, so now we're sitting here and we have really net income, right? All of our revenues minus all of our expenses in our income summary. So if you subtotal them at this point, you're at $1,500. Well, the next step, the third step, third closing entry, is to close income summary to retained earnings. So we're going to close income summary to retained earnings. We want to 0 it out. It has done its job for the year. We're going to make it 0. So we're going to debit income summary for $1,500. And we're going to credit retained earnings for $1,500. There you go. We're going to debit income summary, credit retained earnings. Now, even if you don't do all the other T accounts, I always suggest you do the income summary one because if it's a loss, it's opposite. I'm just going to say those words for you right now. If it's a loss, it's opposite. All right, you may see that with an example, a homework example, but that's why I say I always recommend drawing the income summary T account when you're doing closing entries. Okay, so here's the last, so we just put this income summary into retained earnings, right? So we debited income summary to 0 it out, credit retained earnings. Last step is we close dividends to retained earnings. So dividends carries a debit balance, so we're going to credit that for it to be 0, and we'll debit retained earnings. And there's the account. The final balance in there, $10,300, and that makes complete sense because you had beginning retained earnings of $10,000. You added $1,500 of net income that you made this year, right? $3,500 less the $2,000, and you pulled some out as dividends, $1,200. So really, you only held on to $300 of the money that you made this year. So your final balance there is $10,300. All right, if you were to look at that along with the statement of retained earnings, you would see that that's exactly what happened. Beginning balance plus net income minus dividends gives you ending retained earnings. Okay, so just to show that to you, I'm just going to literally exactly the same thing we just did. You can test yourself on this knowledge. Try it on your own. I'm giving you the solutions just so you can do that. All right, the very last thing we do is we do a post-closing trial balance. Actually, I don't think I had that in the accounting cycle, but we do one more trial balance. And the only thing that's going to be in there are going to be permanent accounts because everything else is zero. We just zeroed out all revenues, expenses, dividends. So the only thing you have left really are the balance sheet accounts, the permanent ones. You'll have assets, liabilities, and stockholders' equity, common stock and retained earnings. All right, so if you're following along with one of the examples that we just did, the one that I just told you to do on your own, you'll see that this is what we're doing here. All right, we would have zeroed out everything from dividends on down because that would have been zeroed out with the closing entries that we did in the previous slide, right? Mark's Bowling Alley. Pretty sure that's the one we just did. Let's see. Yeah, there you go, Mark's Bowling Alley. So if you took it to the next step, here's the solution for that. All right, I suggest you try it on your own. Follow along. Make sure you have the right numbers, and it'll be easier if you understand it now when you go to do it for homework. And like I said, it's got the permanent accounts of assets, liabilities, and stockholders' equity. That's it. See you next chapter.